Principle of Insurance, Chapter 2, IC01, the concept of insurance and its evaluation. You try to understand what is the concept of insurance. You should know about the insurance, how the insurance is evolved. You try to understand how the insurance works. And then we are also going to discuss the different clauses of insurance. Then we will try to understand how to appreciate the importance of the insurance industry. So this chapter is devoted to concept and evaluation of the insurance. Basically, just to understand the concept of insurance, we must understand the need for the insurance. Why insurance is necessary? You see, this is very, very important to understand why somebody should go for the insurance. They say when you are not sure, you insure, something like this. Now take a situation, you have a car. Of course, for car, certain things are mandatory because third party liability. If you are killing someone, if your vehicle is meeting with an accident and it is a third party liability, certain risks are mandatory and compulsory. But try to imagine your car is damaged because of accident, then because of unexpected event. You know, accident it is unexpected event. The car accident, there can be injury to the driver. The risk of the car can get, there is a theft and pilferage. The people will steal the car. The risk of car running over someone on the road, it will cause the injury and it will create the third party liability. So there are various, uh, there is for a human, for a person, there could be untimely death. There could be, he is having a lot of responsibility of kids and wife. The kids are growing, their education, etc. So there is a chance that he will fall ill. The key person will get the injuries. Then there are a lot of expenses like children's marriage, education, foreign going, foreign placement, home loans. So all these risks are there. And if there is an accident and a key person if is dying, then naturally there is going to be a lot of liabilities to take care of this temporary disability or death. The people are taking insurance, considering the premium will be considered considering the life expectancy of that person. Then you have a factory, you have the commercial setup, and then there is a chances of fidelity, burglary, the fire, the flood, the premises can get damaged, the machinery will have breakdown, the ships will get grounded, the cargo will get damaged, the cargo will be stolen. So there are a number of situations that your property, yourself, your cargo, your commercial establishment, they are susceptible to different type of physical, non-physical consequential damages. And then just to take care of that one, you should understand the concept of insurance. The insurance company, what is insurance company? It is normally referred as an insurer. There is an insurer, there is a insured. Maybe people are also calling assured. Normally, this is word used in the life insurance, but even in general, like New India Assurance Company. So the insurer is promises to pay to the owner, the insured, or a beneficiary of the asset a certain amount of money if the loss occurs to ensure the continuance of the financial benefits. The insured pays certain amount consideration to the insurance company for bearing a risk which is known as a premium. So at the consideration of premium, the risk is insured by the insurance company at the given terms and condition which is expressed in the policy. So why it's a very old concept. The Hammurabi Code was also having the insurance concept. So the business and infrastructure related to the protection of the economic value of the asset. You see, my value, there can be fire, there can be earthquake, there can be floods, there can be various perils which something is falling down. There could be machinery breakdown, there could be the explosion, there could be hazardous material in transit, there could be damages in transit. So there are various risk which is exposed to a business, and then just to take care of it, to maintain continuity in the financial losses, not continuity in financial losses, but continuity in the business. You should understand the concept. I'm analyzing the risk. I'm retaining whatever it can be retained with me, and whatever I cannot retain, I will pass it on to the insurance company. What is asset? Asset is a valuable, it's having value to the owners because they give benefits. They are the profit earning assets which I am having. And then to maintain my profitability, I want that assets to be protected in case of accident, fortuity. Uh, it is unexpected events which takes place, and my cargo, the assets, cargo, etc. is getting damaged. So when the insurance was evolved, basically insurance was evolved in 18th century. In 1818, the Oriental Life Insurance Company was the first life insurance company to start the insurance operations in Kolkata. So you should understand about these various the days and events when it started. Basically, the insurance is very old concept. Before 5,000 years back, the Chinese traders, to avoid piracy, they used to load cargo in different boats. So if one boat is sinking or there is a loss because of piracy, then my entire cargo is I am not losing it. Then there is a what we call that Hammurabi code. The insurance was given to cargo by Babylonian traders, the protection against the loss of cargo. This is also an old concept of Hammurabi code. In 1666, the Great Fire of London destroyed more than 13,000 houses. To counter such events in future, Fire Office, the first fire insurance company, was started in 1680. The traders in London get used to get gather at Lloyd Coffee House and agree to share the losses of goods due to piracy or ship sinking or due to bad weather or any other reasons or the perils which were operative. So these are the historic events of the insurance. The history of insurance in India in 1818, the first life assurance company, Oriental Life Insurance Company, was established in Kolkata. 1829, Madras Equitable was established in Madras. Now it is Madras. It was Madras Presidency. Now it is Chennai. In 1850, the first non-life insurance company, Triton Insurance Company Limited, was established. 1870, Bombay Mutual was started in Mumbai. 1874, Oriental was started in Mumbai. In 1896, Bharat Insurance Company Limited was started in Delhi. 1897, Empire of India was started in Mumbai. The growth of insurance in business in India, this has led to the requirement of enactment of the Insurance Act 1938. Then the LIC was formed in 1956, and then the General Insurance Corporation was formed in 1973 with the privatization, with the nationalizations of the various insurance company under General Insurance Corporation, and there were four companies like New India Assurance Company, Oriental Insurance Company, the New India Assurance Company, and then the National Insurance Company and Oriental Insurance Company. There are further changes. In 1999, Life Insurance Corporation of has exclusive right over life assurance business in India, and there is a postal insurance, the rural postal life insurance. So there are a lot of changes, and then the liberalization of Indian sector. The 1999, the IRDAI was introduced in March 2015. In the year 2000, the insurance sector was liberalized. Again, the privatization started. So these are the various, you can say, the changes in Indian sector which you should know. The insurance industry, you try to understand the concepts of insurance. The insurance industry, how insurance is working. So there is initially the concept of pooling started. What happened? There are 100 ships. Now 100 ships put together, if I am insuring it, and then you see every ship will not have loss at a time. Every industry will not have fire at a time. So when I am trying to pool such type of assets in such a way, and I am giving a contribution, and then whenever the losses is there, so in a way it is out of a social responsibility. So what is the concept of pooling? When people are exposed to similar type of risk are brought together. Under the similar concepts, nowadays the departments of the insurance are also segregated. For example, there is a machinery breakdown, then there is a miscellaneous under which there are various type of insurance involved. Aviation is there. In marine, there is a cargo and hull, and then the fire policy, it will take care of fire, earthquake, flood, and sort of losses. So they are segregated with the point of the pooling of the assets. They are the people with various type of assets are put together. Dwellings are there, shopkeepers are there, householder policies are there. So insurance company acts as an intermediary in a way that they will bring all these people together with the commercial interest. They will charge certain premium, and they will see to it that if there is a 100% loss, there cannot be, insurance will not function. If there is a catastrophic loss every time, the insurance cannot function. So it is based on the chances, based on the possibility of losses. So it is the insurance company in the full scenario is acting as an intermediary. Then what is a mutual consent among the group members? So share the loss and compensate the person who has suffered the loss. So that means you can have, like there are many societies they were functioning it. That okay, in the society there are 100 members and one person is having a loss. Naturally, the other people, other social responsibility, uh, they will contribute. It is a mutual consent. The compensation is expected to put the person in the same position, the financially as before suffering the loss. So you are put to the same financial position, and this is basically how insurance is working. It is based on the social responsibility. It is based on, you see, even earlier you look at in the Indian scenario that whenever there is a marriage, the people will contribute to maintain the system of marriage. They will give some gifts. They will give cash money. So this system should survive. The marriage system should survive. And then it is a social responsibility that somebody is having a function. People will, some people will go and give the physical help. Nowadays, with the contract system, with a lot of money, people write that no flowers and no gifts, etc. But initially, if you know that whatever, whether it is a good incident or bad incident, even after the death, people used to give something to that particular family. So at least few days or few months, they can survive without having any serious problem. So insurance company is basically acts as an intermediary. They collect premium, and then whenever the losses are there, they pay to these people. Basically, the insurance company is functioning on the concept of pooling. That means similar type of risk people are coming together, they are contributing as a social responsibility, and whenever there is a loss, it is made good from the pool. Now we have to understand that how it is happening in the car. Let us take an example. There are totally 500 cars, and let us assume that the value of each car is 10,000. But then if 500 cars owners are pulling together, and then they have to work out what is going to be a premium, how much they should contribute annually. So nobody will suffer the losses in a long period. The accidents statistics is available in the that if the cars are 500, the chances of accident statistically is possible. 5 cars will get totally damaged, totally destroyed. Now we see we have to work out how much premium. So the rupee 10,000 multiplied by 5 is 50,000 rupees is going to be a loss. And then how many car owners we have? We have totally 500 car owners. So 50,000 divided by 500, it is going to be 100. So premium should be 100 rupees. So the 5 cars uh, loss will be made good. But then it is sufficient, the person who is pulling it, who is function, who is doing it. So all he also has to have certain administrative expenses. So this person then also, if there are marketing expenses when he is trying to go to various places, and that is the reason, considering various other expenses, say let us assume it is 40%. So 60-40 ratio is maintained. So anybody would like to have the more premium considering the administrative expenses. So you should understand exactly how the insurance is working based on pooling. There are various types of expenses. There would be nowadays the brokers are there, the agents are there, there are marketing expenses, and then these are also considered at the time of deciding of a premium. How fire insurance works? Let us say that there are number of houses, 1,000 houses are there. So value of each house, again let us consider it is 10,000 rupees. It is hypothetical. Nowadays nothing is available in 10,000. So number of houses expected to catch fire in a year. When we say fire, there could be there are other allied perils also. There is a fire, there is an earthquake. Now earthquake, you know that it is a catastrophic loss. Sometimes the earthquake, the tremor may damage the property, may not damage the property. So all the data, all the possibilities of earthquake, the possibilities of flood are available. The fire also, if you try to minimize the losses by having the early detection system, the firefighting system, the separation system, naturally the fire losses would be less. But let us assume that we are expecting 10 fire losses in 1,000 houses. So how much it is going to be the loss, total loss at the rate of 10,000? Let us assume it is 1 lakh rupee. So number of houses are 1,000. The loss is going to be 1 lakh. Uh, so the premium will be again 100 rupees. But then along with the fire, there are various allied perils. Say there is a contamination of oil in storage tank is covered. Then there are many allied perils covered. The impact damages are covered because of say some vehicle comes and hits on my compound. The fire, earthquake, flood, cyclonic condition. These are all the basic things, the basic risk which is covered under the fire insurance. Similarly, you should know that how marine insurance is working. Basically, in Indian market or as such in international market, the marine insurance is divided into two parts. The one part is cargo insurance, the other part is the insurance related to the ships. Now, whatever is in transit, now cargo when it is in transit, be it by courier, be it by rail, road, air, then the ship. So all this mode of transportation is covered under the marine cargo policy. Again, this marine cargo is divided into many groups like dry bulk cargo, liquid bulk cargo, over-dimensional cargo, containerized unitized cargo. And then consider the risk is different. The liquid bulk will have different risk, and then the losses could be total loss, the sinking of vessel, the accident to the vehicles, and the accident to the wagons, etc. But the chances of total losses are much less statistically. There could be quantitative losses, there could be qualitative losses. So considering the percentage of losses expected statistically, or you can say actuarial science, they will tell me, what is expected losses. So for example, they will say that expected loss in particular dry bulk consignment is say 0.5%. So when we come to the 0.5%, that means I know that my premium, if I have a excess provided in the policy of say 0.25%, then my premium should be 0.25%. Of course, I should be adding something for my administrative expenses and the element of profit and some element for the investment from the point of catastrophic losses, etc. So you try to understand that the if there is only one person coming with the insurance, then there cannot be any insurance. There has to be pool. There has to be number of people coming and going to insurance company, and they are trying to cover their risk. Now I will not be knowing 1,000 people for my car. So what I know, I know that I know the insurance company. I go to insurance company. They have 1,000 people's car insured with them. So I go one among them. So this is the way how fire insurance, this is the way how marine insurance. There are different types of miscellaneous policies are there, aviation policies are there, machinery breakdown policies are there. Then there is a loss of profit is also covered. So you should understand the basic concept, how the insurance company is working. Automobile, of course, motor insurance. You should know that it is based on pooling. There are thousands of people. I find out statistically what is going to be my maximum loss, and based on that, I'm deciding the premium to be collected from them. There are different classes of the insurance. The first is life insurance, the old age life assurance, what we call. Now, life assurance, how the premium will be decided, because person A is not same like person B. The risk associated by the life of person A is not same as person B. For example, somebody is going in the office and working in very safe environment will have a different life threatening than person who is going to Himalayas for climbing, the person who is working in circus, and person who is having the paragliding, etc. So the risk, so diving, the purpose who is going underwater. So considering your profession, then your health condition, your family history of the health condition. Maybe there is some diabetes or certain heart problem. It is coming hereditary. So all these things are considered. So they will consider what is your age, what is your sex, in which profession you are there, what are your habits, are you smoking, are you drinking, all these things will be checked. And then of course family history, and based on that, they will definitely will be working out that what should be, and then how much is expected your life, what is your value, uh, in which profession you are. Because a person who is a labor, there is no proprietary that he will take the insurance of 1 crore rupee. So, considering your earning capacity, you would like to have the insurance, and then the premium is decided considering the your life expectancy. That they will say when I'm going to the age of 20, uh, and then if I'm taking a life insurance, they will decide my premium in a different way. Similarly, there is the way it is a life insurance, there is a non-life insurance. So what all the non-life insurance are covered? The first and foremost thing is about the fire insurance. In fire insurance, there are various allied perils which I said. That the flood is covered, the cyclonic risks are covered, and then the earthquake is covered. The overflow of tanks, the impact damages, the leakage and contamination from the tanks. So there are various other perils you can, it is considered under the fire insurance policy. The next is marine insurance. In marine insurance, as I said, that it is divided into two parts. The one is cargo insurance, the other is hull and machinery insurance. What is hull and machinery? Hull and machinery is the ships. What is cargo? There are different type of cargoes are there. Liquid bulk, over-dimensional, break bulk, packages, reels, rolls, containerized cargo. So everything need insurance in transit, because in transit there can be accident. Similarly, the automobiles, the motors, the wagons, of course, the government property is not insured. But there are private railways and they take insurance. The containers are insured. The ships and machineries are insured. So this everything is coming under marine insurance, because ship during cyclonic condition can sink. The ships can ground. Ship can have the collision impacts. The way the road vehicles can have the impacts. Then there are miscellaneous section in the non-life insurance. So what is covered in the miscellaneous? There is a motor, there is a you can say uh, the the motor, the liability, the health and burglary, theft and pilferage, everything is covered. But in general, if you see in the health insurance, the medical claims are reimbursed, the medical policies are issued, the personal accidents are covered, the accidents are covered, the losses during traveling, it is also covered under the health. Because if I go to foreign place, I require medical health, and then it is very expensive, so which is covered under the policy. Miscellaneous, of course, there are engineering liabilities, the machinery breakdown, engineering, and then there is the automobile, etc. So various things are covered under this. So you should know basically there are marine, life and non-life. In non-life also there are fire, marine, miscellaneous, motor, aviation is also there. So there are various types of cover which is dealt separately. The person who is looking after aviation will not look after the fire insurance. The person looking after fire insurance will not look after the say health insurance. So these are separated departmentally uh, uh, the handle. We have already discussed this aspect types of insurance in earlier slide also. So as I said that it is divided, the full insurance market is divided into life insurance, life assurance and non-life assurance. So the life insurance is covering the lives of human beings, and the non-life insurance is covering the non-human objects. So non-life insurance, it is having fire insurance, covers fire-related risk. Marine insurance covers transportation risk related to sea, air, rail, or road or ships. Miscellaneous cover motor, vehicles, engineering, burglary, fidelity, health, liability, etc. So basically, how insurance is working, it is a pooling. Then the insurance company takes the premium, and whenever the losses are there, they will appoint a surveyor. He will inspect the loss and quantify the loss in terms of money. The insurance company is also reinsuring the full portfolio. So, for example, there was a case of our satellite Aryabhatta, or there could be a very big ship, ultra large crude carrier, which is costing say $300 million. Now, when I go for the $300 million risk with insurance company, they may not be in position to accept such a huge risk. So what they do first thing, they will try to divide into another insurance companies. For example, there are another 10 insurance companies. So they will try to put, they will keep a major share, say more than 25%, 30%, considering their retention risk. And they will spread over. They will go to other insurance companies and ask them that you take the, you take the insurance, you also you share in this particular thing. Also, when I feel that no, my retention capacity is much less, or other people are not accepting, I go to London market, in the reinsurance market, Singapore reinsurance market. In India, General Insurance Corporation, it is also a reinsurer. So certain percentage of share will be retained by them. It is also a major reinsurance company. So this is the way how insurance is functioning in the market. That it is a acceptance of risk, retention, and then transferring of the risk. And whenever losses are there, you make the loss good. So how the risk management can be undertaken by individuals. So basically there are four ways, how manage the risk is managed. One is avoidance or prevention of risk. Risk cannot be, you see, it cannot be completely avoided, and these are often caused by natural perils or actions of others. It can be action of others. For example, as a kid, your parents will say you, no, 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 you should not use the motorcycle because motorcycle is risky. So they will not give you motorcycle. That is with they are trying to avoid the risk of any accidents because of your age, and maybe your way of thinking, your way of looking at the life, etc. But that is the avoidance of the risk. A person who is scared of mountaineering, he will not go to mountaineering. So this person will never fall, he will never die by falling on the hills because he is not going there, he is avoiding the risk. But can you avoid the risk completely? No. My father has not given me motorcycle, but then when I am going on road, I am walking, some other motorcycle can come and hit me. Some other vehicles can come and hit me. Some cyclists can come and hit me. So the risk still remains, even if it cannot be totally avoided. But the first and foremost thing is you find out what is the risk. Why parents are not giving motorcycle? Because they have analyzed the risk. The maximum possible loss is death. And then there could be injuries. There could be fatal injuries. There could be life-threatening injuries. There could be a long-term, the say breakage of bones and sort of things which will never be cured. So there is a avoidance of risk. Then they calculate the risk. What is going to be a risk, and then they say no, we are not accepting, or we are accepting the risk. So this is the way how person is trying to avoid the risk or prevent the risk. Now prevention of risk, what you do? Let us take smaller example of motorcycle only. What you do that your parents will say that okay, I'll give you motorcycle, but you should be using helmets. So now with the helmet, the chances after accident and death is minimized. So you should have a good helmet. There can be a very good type of uh, suits which is available for the motorcyclist. In Indian market, you will not find that one. But with such suit, even if you fall down, the chances of damages are it is reduced considerably. Okay, then there can be a smart person. He will say that no, your speed should not be more than 60 kilometers. So he may log the speed. So there are many techniques for preventing the losses. For fire, how you want to first thing you want to assess. You want to the moment there is a smoke or heating, etc., you will get the announcing system. There would be instrumentation which will tell you. Maybe the automatically sprinklers would start. Maybe automatically that particular compartment would get flooded. All these things can be done, which is from the prevention point of it. So if you can avoid, avoid. If you cannot avoid, then try to prevent the risk. After that, what is there? There is a reduction of risk. What is reduction of risk? It is possible to reduce the risk before or after an incident has occurred. So whatever is the damages has taken place, try to see that you get the salvage value out of it. Try to see that this risk can be totally reduced in the full process. Maybe there are various techniques of reduction of risk, that you are segregating the atom. The warehouse management is done such a way that hazardous goods are kept in a separate compartment. It is so separated that even if something goes wrong, that will not affect the other atoms which is kept. So in a way, I am trying to reduce the risk by various techniques of segregation and then storing in such a way, and my logistic management is such that I'll try to reduce the risk. Now I know what is the risk. I have quantified the risk. I have tried to avoid the risk. I am trying to prevent the risk. I have tried to reduce the risk. But then still after this, when I have quantified the risk, I know that if this takes place, maybe it is a 0.5%. If this takes place, I will be put to a major loss. So how much risk I can retain? If my value of my property is say 1 crore rupees, if it is totally damaged, can I retain? Can I have this 1 crore rupees as a funds to reinstate that one? Then I said no, it is not possible now. I cannot have the reconstruction of my property which is costing 1 crore. Then what I do, I go to the insurance company. So I transfer my risk. Partly I pay them premium, and then I transfer my risk to them. Even insurance company, they feel that yes, I have now 1,000 crores of properties insured with me, and if there are even say 10 properties damaged, 10 crores, so it is going to be a huge risk to me. They will reinsuring by payment of premium, etc. So in 10 crores, maybe their retention is 10% or 15%. The remaining thing they will get it from the reinsurer. So this is how the risk management is undertaken by individuals and insurance companies. So what we have seen that there are various types of risk, and we should try to identify the risk and assess the What is assessment of risk? That if at all it takes place, what is going to be a financial effect of that particular uh, the peril which is operative. I am trying to find out. I am quantifying uh, the risk uh, in terms of money. I am trying to identify an assessment I am doing. Now what I can do, that once I know this is my risk, then I will prevent the risk and I will try to avoid the risk. For example, my entire building is of RCC, cement concrete. My even cots, etc., this is made out of a steel. Of course, there would be mattresses, clothing, etc., which can catch fire. But if I try to keep it minimum fire uh, prone or fire thing atoms in my house, then the chances of fire damages are much less. Say, for example, I know in my area the flood limits are never more than 3 feet. For last 100 years, the record indicates that there was never water flooding more than 3 feet in my area. So, if I have the plinth more than 3 feet, or if I have the entire structure, it is elevated, and only I give a about 3 feet a car parking, and then from first floor I start living, the chances of flood damages and the chances that my building will get damaged because of flood, it is much less. So what we are trying to do by construction, the earthquake prone constructions, the plinth height increasing. So I am trying to prevent. These are the techniques for prevention. The flood damage cannot be avoided. The fire damages, yes, you can try to minimize the damages by minimize the uh, the the incidence of fire. But earthquake, can you stop? No, you cannot stop. So what I should have the, like Japan, the housing should be of a earthquake proof. It should be such constructed that with certain Richter scale, nothing will go wrong with my housing. So I'm trying to reduce the risk, by considering prevention, the well designing, and then trying to have the instrumentation for early detection, and then taking corrective action, etc. End of day, I'm also trying to. I know what is my risk. My risk is, say, for example, 10,000 rupees, but my capacity is not to retain that risk. So what I will do, I will insure it with the insurance company on a reinstatement basis, on a replacement basis. Every insurance is not given on reinstatement or replacement. It could be market value, but then housing, my house, I can take it, because the concept is something like this, that if there is a fire and my house is damaged in totality, with the depreciated value, I can never reconstruct that one. And then the insurance company appreciate the concept of reinstatement value, replacement value. They are taking premium based on reinstatement value, and without depreciation, they are paying your losses. So this is the retention, how much you can retain, and then how much it can be transferred. Transferred to whom? Insurance company. And as I again said, that insurance company is also not retaining the entire risk, considering their retention capacity. They will go and place it with the reinsurer company. Although it is not directly connected, but then this is the way how a gambling is also working on the, what we call a gambling system of matka. Now there are 0 to 9 numbers, there are 2 numbers, there are 3 numbers putting are, the punters are, booking. Now there are hundreds of bookies. The bookie will say that, okay, I have the maximum the offer for number 6. Similarly, then if I have maximum booking on number 6, I will reinsure that one with the other upper bookie. So he also collects the from various bookies, how much is the punters are betting on that particular number, and it will go to the final stage. But in gambling, sometimes what happens, the person, suppose a person, let us say a person like Ratan Khatri, who is managing the entire show, once he understands from the second down the grade bookies that the maximum booking is on number 6, that number 6 will never come out. They will never declare that number 6. But in case of insurance, this is not like that. In insurance, it is an accident. The accident, it is, it can be prevented, but it cannot be 100% avoided. And then that is the reason this concept is different. The gambling and wagering is not is a part of your insurance contracts. So one should understand this. Similarly, this is also happening on the pattern like gambling, but gambling is controlled. Gambling is controlled by a person, whereas insurance chances cannot be controlled by human beings. So basically, what we have seen, I am trying to summarize everything. What we have seen in this chapter, that insurance, it is divided into two groups. One is a life insurance, other is a general insurance. And then the life insurance can also be divided into whole life insurance, the term insurance, the annuity insurance. So there are various types of insurance in life insurance. Whereas when you say general insurance, the general insurance can be divided into fire insurance, marine insurance, and miscellaneous insurance. Now, miscellaneous insurance is also grouped like vehicle insurance, fidelity insurance, credit insurance, burglary insurance, loss of profit insurance, workman's compensation insurance, professional indemnity insurance. So you name the risk and then the insurance is available for that particular risk. So overall, you should know that there are various methods, various types of insurance available because the risk is different. There could be in commercial, individual, personal, there could be a different type of risk and the insurance is available for all this type of risk. So why this insurance is very important to the industry? Because the insurance is providing you a very steadiness in the stability of trade and industry. Because I know that if there is a fire, it is not going to be a full loss. My business will not be shut down. I have taken the insurance and partly it will be made good from the premium what I have paid. Then I can take the risk taking ability for trade and industry. What risk I am taking it in the trade and industry? That there are certain decisions, they are risky, 50-50. But then if I take that decision, the chances of the profits are much more. But the risk taking the risk taking, I can transfer that risk to the insurance company. Of course, it is a calculative risk. It is not a risk because of gambling and staggering. But then certain things, say for example, I'm not sure about dispatching a consignment to particular place. But then if I take the risk, the chances of profit will be much more because it is going, my consignments are going overseas. I have to take the risk considering the profitability. But I am not sure that what happens if the ship sinks or something like that. And then if it is insured, I am sure that if at all, even if it is sinking, or there are export credit guarantee insurance is also there. So whenever this is the government insurance, it is giving a facility to the exporter that you don't worry, your credit, whatever you are giving, it will be guaranteed under certain circumstances. Of course, there are terms and conditions. So these are the things, this is giving a very uh, uh, facility to the trade. It is also providing the protection against the losses due to vagaries of nature. You see, natural losses cannot be controlled at all. Can you control cyclone? No. Can you control the flood? Yes, you can say in a way, if the cities are designed in such a way, the water draining system is designed in such a way, but still there could be cloudburst. There could be the system which will not take care of this cloudburst and flooding. So there are various things can be controlled. The fire, yes, fire. If I considering the risk and then the hazardous material, the fireproof material, the there can be a fireproof walls, fireproof panels, fireproof material use, etc. That can be reduced. But the vagaries of nature, like bush fire, forest fire, it is very difficult to avoid such type of thing. And then that is the reason insurance is very important in day-to-day life of modern society. Now, everybody should know about the Export Credit Guarantee Corporation, ECGC. This ECGC or Export Credit Guarantee Corporation, it is providing protection for the risk related to international trade. Now, importer payment is at default. The currency appreciation is at risk. The changes in economic policy is at risk. So there is a cover given by Export Credit Guarantee Corporation. So there is a liability insurance. It can protect the professionals. But of course, this is a liability insurance is not part of the ECGC. But then there are professional indemnity policies are there, like professional like doctors, lawyers, accountants, engineering, who had the risk of being charged with negligence, that and subsequent liability for the damages. A doctor's wrong decision, uh, the result is there could be a legal uh, suit against him. So to defend all this thing, he is not doing it purposely. It is not. There may not be any negligence also, but then it is a professional indemnity which is covered by the insurance company. So amount claimed for the damages can be fairly large, beyond capacity of the individual to bear. And that is the reason private limited company, the limited company. So the person who is having this business, he is limiting his liability considering the overall business profit. The proprietorship or the individual, they cannot limit their liability. So accountant can be used by a client, and if she or she faces a loss because of wrong advice, so he will have there will be a liability claim against the accountant. An engineering company can be sued if the bridge falls down, and then there could be claiming some life. A doctor can be used if a patient dies because of the doctor's negligence. So there are liability insurances, there are export guarantee insurances. So the every part of our life, it is having the risk, and that every risk it can be covered with the insurance company. Now to summarize the entire chapter 2, we can say that insurance is very much required to protect the risk associated with the life, the risk associated with the assets what we have, and then we also should continue the earning and benefits from the assets what we are enjoying. The insurance, what is doing? Insurance is transferring the risk from the asset owner to the insurance company in return for a fee which is known as a premium. Even the insurance company, they are having the method of transferring the risk to the reinsurers. So you should know the system how it works. The first written insurance policy was in a Babylonian, obelisk monument with the code of King Hammurabi. In India, the first life insurance company was Oriental Life Insurance Company, which was started in Kolkata in the year 1818. There would be question on that because this is the first insurance company, life insurance company. In India, in the year 2000, the insurance sector was opened up to the private players. Uh, there was an introduction of IRDAI, Insurance Regulatory Development Authority of India. The insurance works on the concept of pooling. Okay. Whereas the people exposed to the same risk are brought together by the insurance company, and the premium is charged considering the exposure of risk and the cost of their property. The insurance is mainly divided into three categories. One is health insurance, other is life insurance, and third is general insurance company. And then the insurance is promoting the trade and the commerce, and it is a very much part of our life. So thank you.